Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today would typically be the mayor, the smartest guy in the room, Mr. Michael Becker, but he is on another due diligence assignment, and we welcome Mr. James, the Professor Eng, into the podcast.
Hey, Paul, how's it going?
It's going great, James. Thanks for being in the podcast. We appreciate that. I heard you were skiing last week. How was that?
We got a couple runs in. It was a little bit cold, but we got a couple runs in, and we got to ski and snowmobile a little bit. So it was a great time.
And you took up some clients in that
Yeah.
trip?
Yeah. So we had 3 or 4 clients who've done a lot of business with us the past couple of years. And so it was a great time.
So it's what, $100 million in business with you. You can take them on a ski vacation. So good for you.
Plus or minus.
That's right. All right. So what's going on in the Old Capital world these days, James?
A couple things. If you haven't signed up for Hoops for Homelessness, that is on Saturday, March 30th here in Dallas. So that is a 3-on-3 half-court basketball tournament. We have about 14 or 15 teams already registered. And so pretty much every listing broker in Dallas is going to be there showing us what they got in terms of basketball skills, and all the proceeds for that will go to City House. And then that week also, we were going to have our next Old Capital speaker series with Mark Dotzauer on Wednesday, April 3rd. So that one is going to be a big one. We had probably 200 or 300 people at the last one, but this one will have 400 or 500 people there for him. So if you have not registered for those 2 events, you can go to oldcapitalpodcast.com.
Yeah, the doctor is making a house call. He's coming to the Grapevine Convention Center. Make sure you go to the Old Capital Podcast and register RSVP for that event. As James says, but before 500 people there. He comes every year and gives us a little boost of confidence, or tells us really what the real story is in English about what's going on, and you really do want to attend that event. So we're excited to have Dr. Dotzer there. Also, too, don't forget we updated the 18-page white paper report on multifamily financing 101. If you're looking to try to put together your own transaction, you do want to have the inside information on how these deals are put together. So we encourage you also to go into the oldcapitalpodcast.com, download the 18-page white paper report, and don't forget there's a due diligence checklist that Michael Becker has provided. And don't think about getting into a transaction without downloading that and kind of figuring out what you need to look for when you are under contract looking to buy a property. So the due diligence checklist on the oldcapitalpodcast.com. So in the podcast, 2 of our friends. Now you've heard this guy before because he's been on the podcast once or twice, Justin?
Once, about 2 or 3 years ago.
2 or 3 years ago. So we're going to have Justin on the podcast and our buddy Matt. Matt's on the podcast. Matt, thanks for coming in.
Thanks, Paul.
You're coming all the way from where?
From Boston, Massachusetts.
Boston, Massachusetts. And Justin is a local boy.
Yes, Arlington, Texas.
Local boy done good.
Yes.
He's an award winner. Matt, do you know what he's an award winner on?
I think he, was it a cotton candy
Several
taco?
cotton candy taco last year. Yeah, that was our 4th trophy.
So
Big Tex Choice Awards.
So Justin Martinez is famous in the Dallas-Fort Worth area because every year him and his family win the Covenant Deep Fried Award here at the Texas State Fair, and they do a great job. Name 2 or 3 things that you have won the champion award on.
We, of course, last year was Cotton Candy Taco.
Cotton Candy Taco.
Then we got a crowd pleaser in the fried Thanksgiving dinner that we won in 2013 for. Then we go with a beer, Funnel Cake Ale, that we won for, teamed up with a local brewery on that, and people love that one because we got the powdered sugar rim.
Wow.
So 3 weeks out of the year, the State Fair of Texas, and I'm just fortunate enough that we do well, and that's what allows us to do multifamily investing. So they go hand in hand. I like it.
What is the thought process in coming up with the next one?
Oh my gosh, you got to get crazy. That's where we have fry parties where I bring my family and friends, a little wine, a little beer, and then we just start throwing stuff in the fryer and start getting creative. It's so much fun. The fun part is frying it. The hard part is trying to find the execution of making 50,000 units. So once you win, you're like, oh my gosh, how am I going to do this? But it's fun. We enjoy doing it. So probably March, April, we start gearing up, start processing what can we do for next year. It gets tougher and tougher for sure.
So Justin's absolutely a very talented person when it comes to frying food in the state of Texas. But Matt is also a talented person. So I want to kind of begin with Matt and kind of talk a little bit about what your background is and tell us where your talent lies.
Oh, thanks, Paul. So, yeah, I guess when you're talking about talent, I started off my professional career actually in theater. I was an actor, singer, and dancer. I grew up in Orlando, Florida, and I moved to New York City where I went to a musical theater conservatory, graduated from there, and spent 5 years as a professional actor, singer, and dancer. I then segued during the big .com bubble into technical things. I taught myself HTML, and I actually had my own little boutique agency, digital marketing agency in New York City for about 5 years. And then the .com bubble burst, and a client of mine brought me in-house, Showtime, the cable television channel, and I worked there for 5 years. And from there, I sort of segued into sort of the advertising world. A lot of the advertising agencies were doing this big, robust site development. And so during my time there, I really transitioned more into a project management role. I'm actually a PMI certified project management professional, which is a certification for that. And I think I realized that where my talents really lie is in sort of analysis and putting together pieces of puzzles and motivating people. The types of tasks that you would see a project manager do, making sure things are on time and on budget. It's funny, when I was an actor, I actually used to keep, this is really before a lot of people had personal computers. I had a piece of paper with a grid on it, and I would put in a grid like every single, like I went to this audition at this time and I read this monologue, or so that I was keeping track of how well I was doing using the different monologues or songs to see sort of what my conversion rate was on different things. Sure. And it's funny because I sort of do that now when it comes to the apartment investing, but that's, I think, really where my talents lie.
So, James, we have two talented people. You're the most talented person I know in the room here. I'm going to turn it over to the Grand Inquisitor, James Eng.
So how do you go from those two backgrounds into multifamily? Like, sort of, was there a conference or was there a event that happened in your lives where you say, okay, well, this is great, this is what I love to do, but maybe there's something else out there that I should be pursuing? So maybe, Matt, if you want to take that one and sort of give us a little bit of how did you transition from that role into what you're doing now?
Sure. As I was growing up, my father was a residential realtor at one point. He later went into catering, which is where there's sort of a connection with Justin. But at that time, I just sort of learned the very basic concept of that you could actually purchase a home that you don't live in and rent it and eventually make money. So fast forward many years later, when I was in New York and working in the advertising agencies, and I had a good amount of income coming in, I was putting money into sort of 401k, that type of thing, but I also had additional revenue, and I wanted to start investing in things. So I started investing in real estate. I started by investing in a vacation home that I actually bought the land and built a home there, and would rent that out, and saw that was profitable. And then I started getting involved in doing some flips and doing some single family buy and holds. And I wanted to sort of expand that more, but I had a very good career going. My wife ended up sort of out of the blue getting an opportunity in Miami. And when we moved to Miami, I decided to make a transition to go full time, and was trying to continue with this model that I had, which was a single family model, and was learning more, listening to podcasts, found out about the real estate radio guys, and found out that they had a seminar on a thing called syndication where you could actually raise capital. I thought if I wanted to buy a large, a $10 million apartment complex, I would need to find a very wealthy benefactor or, win the lottery to go ahead and purchase that. And when I found out about syndication, it really sort of opened my eyes. And that was when I first started to get involved in multifamily.
And so, you hear it on a podcast or you hear it on the radio, and then you got to take action at some point. So did you go to a conference or an event or come to Dallas, or how did you you and Justin connect?
I did. I read Rich Dad, Poor Dad probably 20 years after everybody else did. But one of the things that stuck with me that Kiyosaki had said in there was, if there's like a seminar or something that you hear on the radio, like you should go to it. And I had gone to one before and it was fine. But I heard that the real estate guys had a syndication seminar. So I went there. Michael Becker was speaking there, so I got to meet Michael
The
Becker.
Michael Becker
I
was.
did. I was very honored. I actually had lunch with him and a few other people. It was great. And I also heard a guy named Brad Sumrock speak, and I met Brad and spoke with Brad, and he has a program, which I'm part of. And so I went to Brad's program. He has a weekend that I went to, and then I joined the program. And I was in the program for a while, and then I started listening to the Old Capital podcast, and I heard Justin talk on it. Justin was in the program. I had heard of him, but we had never met before.
No, I don't think so.
Yeah. And his background sort of in the culinary arts, if you will, doing the same stuff. I mean, my dad, caterer, was doing a lot of these sort of events, concessions. So I went up to Justin and said, hey, my family kind of has sort of the same background that yours does. And that was, I think, the catalyst for us to start to get to know one another and build a rapport.
Yeah, it was, because typically, when somebody would come up to me, it was mostly real estate focused, but a guy that actually understood the culinary side and my side, the food and beverage business. I was intrigued, and we clicked from the beginning. And that's what's important in partnerships, with any business, but especially in the multifamily business. And I think from there, we just started connecting by phone and started to analyze deals. And here we are now with this 2-property portfolio that we got.
So when you guys, a lot of people will join a program but not actually take action on a deal, whether as a passive or even as a general partner. So maybe give us that progression. Okay, you sign up, you put some money down, you go to conferences, now you got to invest your money into a deal. And so maybe tell us, did you start as an LP, sign on as a KP, and then how did you get to this deal that we're going to talk about?
Sure. Well, I was fully committed, 100%. I was pretty much committed even before I went to Brad's weekend. I was very impressed with Brad, and I felt like from the real estate guys weekend, I had a very good understanding of syndication, and I had been working in real estate as a hobby on the side, but for 10 years. So I felt like I had some good experience under my belt. So I joined. Brad has a couple different levels. I joined at a higher level where I was really wanting to get that personal one-on-one mentorship from Brad and get really involved in the ecosystem he's created. So I did that and immediately started to learn how to look at deals. It took about 6 months before I think I was actually meeting with brokers and really analyzing deals. But pretty quickly, I started investing in deals as a limited partner. So, there's a number of different people in the group who I got to know. I think it's important that you invest with people come to me all the time and ask me for my opinion on a deal. And my first question was, how do you know the person who's sponsoring the deal? Because I think that's the most important thing. I invest, obviously, I want to see the underwriting on the property and make sure that makes sense. But my first criteria is, who's that person? Is it someone that I know, like, and trust? So I was building those relationships to get to know people, get to know their track record, speak with other people who maybe invested in another person's deal. So I would get sort of a gut check on who the person was and started investing as a limited partner.
How much money would you put into any one transaction as a limited partner? 25, 50,000?
When I first started, yeah, I was more around the 50. The first 2 transactions was 50.
That's a pretty good level just to put your big toe in the bathtub to kind of figure out if you like it or not. 50,000.
Yeah, I think so. I mean, most of the deals that I see have a minimum of 50 to 100. I do see deals once in a while that are at a 25K level. One point, I guess when I first started, I thought, gee, I'd really like to just put $5,000 or $10,000 into one of these deals. But when you look at, this is a 5-year deal, you're going to get K1s every year. If you're preparing your own taxes, it's time, or you have to pay an accountant for it. It just doesn't, the administrative costs are so expensive that I don't think it really makes sense unless you're at least the 25K level.
Well, to add to that, I think it's so important for a new person into this business to be a passive investor. The main reason why is, yes, of course, you want to put your money to work, but getting that experience of do you interact with the deal sponsor? What kind of documents do they send you? What documents do you fill out? It's just a great way to not only work your money, but gain the experience you need to eventually get in that driver's seat like Paul talks about and be a deal sponsor. So it's a great stepping stone to eventually become a deal sponsor for sure.
So once you made the decision that you're going to be a general partner, did you make a decision that you were going to partner together, or did you say we're going to take it deal by deal? Because I know a lot of people get stuck on that part of it where they're like, all right, I'm on my own, but I'll maybe bring in a co-sponsor depending on the deal. So maybe talk about when you started looking at deals and then actually landing this deal that we're going to talk about. What was that timeline?
Well, I was a limited partner in a number of deals, for partially for the cash flow, but also for the reasons Justin was talking about, to learn and see how people do their deals. And then I became a KP in a deal. And as I was looking at these deals, I had always in mind that I would want to bring a co-sponsor in, somebody who has more experience than me, who has the background that I think will help take me to the next level. I had already been a KP, so it's not that I needed someone for, to get a non-recourse loan, because I was already had signed on one. From a capital perspective, I felt very good in terms of, my own capital. I'd probably need some KPs on my deal to meet the loan requirements. And I felt okay about the capital raise, but, while my own network knows me and knows that I've been in real estate for 10 years, they also know I've never bought a 100-unit property. Sure. So to bring in somebody who's done this a number of times was important. And based on the relationship that Justin and I sort of organically cultivated, he was a natural choice for me to go to. So, we didn't have any sort of like agreement or partnership.
This right moment, we did not have that. No, and that's the thing. I totally agree. It definitely happened organically. So him coming to me to help analyze the deal and not only analyze the deal, but analyze the markets. I got to know him on a personal level, just how we interact, how we connect, but also got to learn his skill sets. And as he talked earlier in the podcast, those skill sets that he has already in place transitioned really well into multifamily. And for me, seeing a partner like that intrigued me. And I said, you know what, if Matt does ever come to a deal, I'd be interested and like to join him on that. And so down the road, that did happen. It formed. He got a little frustrated. I'm sure we'll get into later, but we finally hit one, and it was just a natural fit. And it makes so much more sense to work with somebody that you get along with and you can interact with. And yes, you might have disagreements, but you can work on those agreements and try to find out what the best call to action is on that.
So how did you find this deal that we're going to talk about, Sunrise?
Through a lot of hard work.
Okay.
Yeah.
So talk to us a little bit about the process. Sort of, did you identify a market? Did you identify a property manager? How did you sort of land on this deal?
Of course. Yeah. So, I think Justin was sort of alluding to my frustration. I originally was looking in the Florida market, which is where I'm from. My parents still live in Orlando, and I was living in Miami at the time. And, got to a couple of situations where I finally found a deal that looked like it made sense on paper, would put it in an LOI and wouldn't even make it to best and final. Or a couple times I made it to best and final and we get blown out of the water by like $1 million. Just the market there is that strong, and it's great that market is strong, but didn't fit the model that I was looking for. So I decided finally to diversify into another market because it takes a long time. So I chose the Kansas City market. And I chose Kansas City because in my prior career as an actor, I had spent a summer out there and really liked it. And also have a very, very good friend who lives there. So it seemed like a sort of a little bit of a safe environment that at least I knew one person in that town. And I spent a lot of time going there. The first time I was there for a week, meeting with brokers and property managers, and then started getting deal flow, going out, looking at deals, analyzing deals. I found a property management company that I really liked. And, continue to look in Florida, and will always continue to look in Florida. But there were some good deals there. And I was analyzing a deal, and I had gotten to the point where I wanted to get feedback from the local property manager and was reviewing it with them. And we were talking about it. Didn't seem like a good deal. And she said, "Oh, you know what, Matt? One of the properties that we manage, I think they're looking to sell.
Okay.
Is that something you would be interested in?" And she's like, it's a C class, C plus, maybe B minus area. And, it's a value add. And I mean, it just ticked off all the boxes in my criteria. And I was like, yeah, sign me up. Okay. She introduced me to the broker there, and it was a broker I had not met with before. And that's kind of how I found the property. So it was really through being in that market, looking at deals, talking with people, and getting, building relationships. I mean, you always hear, I've always heard that this is a relationship business. And what I've been finding now through being in this business is that's absolutely 100% true.
Yeah, and to add to that, I'm lucky enough to be a coach of Brad Sumrock's program and since 2015, and so I've had the privilege to coach many different people across the country. And the two things that I noticed from Matt from the beginning was commitment and persistence. And that was the thing that separated him in order to get his first deal. And I'm sure the next few deals are going to be a lot easier, as we've heard in this business. But I noticed that in him. And we even I remember the phone call he called me. He's like, I'm frustrated, Justin. This is what's going on? What do I need to do? And I, as somebody that's been in the business and I have multiple deals, there's no one answer. It's just continue to be persistent, commitment to your trade, which is C-class, B-class multifamily investing. And regardless of what business you're getting into, I think that's the key, is to stay committed, surround yourself with the right team, like Gold Capital, and find the right co-sponsors, find the right networking environments like Brad Sumrock's program, and then just stay with it. And he did that. And so, after a year and a half, he did that. And I think he's on his way to be a very good deal sponsor with multiple deals.
Talking about being a mentor, you're a mentor with Brad. So tell us a little bit more about your investments. I mean, how many units do you own, whether you're a passive or a lead-in? How many?
Sure. I'm in over 1,200 doors across 8 states, 6 cities. I joined Brad Sumrock's group back in March of 2014 and took the advice of everybody into the program of get educated. So I'm not only educating myself through the webinar training and the networking, but also getting in a few deals as a passive investor. I wanted to know how they interact with me. And then once I felt ready and take the driver's seat of that car, that's when in September of 2015, got my first deal in Oklahoma City, Highland Oaks, 84 unit.
Sure.
That was the one I was on here for.
Yep.
And got that one. And then after that, it was off to the races. The hardest one is the first one. And they're right, because you're not well known at the time. And then as soon as you get your first deal, you just start going after it, and off-market deals start to flow in. And to add to the coaching, I had, like I said, had the privilege to coach Brad's students all over the country. So naturally, I got to form great relationships with a lot of different deal sponsors, including Matt. And that's what led me to be a co-sponsor in 12 deals.
So on this particular deal, going back to, so tell us a little bit more about the deal, sort of how it looks, what you liked about it. And then, a lot of these deals now are going to sort of a best and final. So if it was off market, how did you get comfortable with the price you were paying? Because sometimes that can be difficult. The seller wants a really high price and they won't come off of that. So maybe give us a little bit of background on that.
Yeah. So I'll tell you about the properties first. It's a portfolio of 2 properties. They're located in Lawrence, Kansas, which is in between Kansas City and Topeka, the home of KU. So
Kansas University.
The University of Kansas. Yeah. Rock, chalk, Jayhawk.
So Justin lives in Dallas. You live in Boston.
Yes.
Properties in Kansas.
Correct.
Was there any apprehension about buying a property?
No.
So far away?
No, there would have been. But I had already invested passively in a number of deals that were across the country. And some of the sponsors had purchased properties in places that they did not
All right.
live.
Paint a picture in somebody's head of what this property looks like. You said it's 2 properties in Lawrence?
It's 2 different properties in Lawrence. They're 1.8 miles from each other by the car, but like by the crow flies, they're less than a mile from each other. One is 64 units. The 64 unit property is a little bit nicer. It's right off of 6th Street, which is a major thoroughfare there. And it's all 3-bedroom and 4-bedroom townhomes. The 3-bedroom townhomes have garages. The 4-bedrooms don't.
What year was the property built?
That property was built in 1986.
And how many are students on that property?
Less than 10% across both.
How far away from the campus?
That one's about 2 miles from the campus.
Individually metered, master metered?
Everything's individually metered.
So the tenants pay all the
Correct.
electric utility
they pay
bills?
Everything.
Flat roofs, mansards?
Pitched roofs.
And let's walk over to the other property.
Yep. And we have the leasing office located at that property.
Okay.
The other property is 68 units. It's about a mile from the university. It's right on 9th Street, which is not it's an intermediary road between 2 main roads, and a lot of people traverse that to get to the downtown Massachusetts Street, which is their big main street. So it does get a lot of traffic, which is very appealing to us. It's 68 units. They're all 2 bedrooms. And 24 of those are apartments, and the rest of them are townhomes. And some of those townhomes have basements.
What kind of condition is the asset in, would you say, when you guys bought it?
I think the Sunrise Village, which is the one off of 6th Street, the first one we talked about with the larger unit size, was in much better condition. It had much more curb appeal. Would you agree, Justin?
Yes, I agree with that.
The other units, the one with all the 2 bedrooms, had quite a bit of deferred maintenance, which, we're in our 6th month of operation right now. We're in the middle of curing that. Things have been going extremely well, but there was a number of things we had to do.
Any amenities in the property, like a pool or playground, anything that helps the tenants out?
Yeah, they both have pools.
Both of them have pools.
Both of them have pools. And the pool with the 3 and 4 bedrooms, that one is larger, and there's a big sort of grassy space and then a dilapidated tennis court.
Any ideas what you're going to do with the dilapidated tennis court?
Yes, we're going to take the tennis court and that green space and convert it into we want to see where our CapEx budget ends up being. We'll definitely be putting a playground in there, and we may also be putting a dog park in there.
Huh. Interesting.
Yes.
A lot of different stuff.
Yeah.
So 2 different pools.
2 different pools.
Okay. James?
Are most of the people working at the university? You said tenant concentration is only 10% of students, but what about where do most of those tenants work, and what sort of employment is in that area?
So about a third of that town is either students or employed by the university. So I would say about a third of our tenant base has some sort of connection to the university. There's a lot of other interesting employment drivers over there. There's a Hallmark production facility there. Berry Plastics there's different manufacturing. There's a Aero garage doors. There's lots of different types of things. So it's definitely like working class, blue collar tenant base.
Yeah, to add to the submarket and the market, that's one thing that we look at. We look at industry data, and being able to look at deals and submarkets all over the country. When he first brought me this deal to review, the fundamentals were fantastic and always in comparison to DFW, right? And it's strange, but the fundamentals there in Florence, Kansas are very similar to DFW. Yes, of course, there's a lot more population, but what I noticed is that historically and currently that vacancy was really low, that had a diversification amongst industries where people were employed, where I felt was very strong. The rental growth was strong, and so all the fundamentals that we look for in multifamily were there, and with a little higher cap rate, which obviously helps us as a purchaser. And so all those together with a strong industry base, with the university, as well as the great fundamentals, really got my attention. And I think that's one reason we really wanted to dive into this market and get this deal.
And how do they find you? How do the tenants find you so that they can become, from future tenants to real tenants on the property? Do you guys advertise? Do you have a website?
Yeah.
Do you put flyers out? How do they come in?
Yeah, great question. We do a number of different types of marketing outreach. Craigslist is actually a big driver in that area. We also do Google AdWords. So my background previously working in digital marketing, I know how to go in and do AdWords. So I've been able to spend some serious time sort of tweaking that up, and it's doing very well.
Website address? Is someone to take a look?
Oh yeah, the website address is sunriseapartments.com.
Surprised that was never taken.
Yeah, I don't know, but that's what it is. It's sunriseapartments.com. And then once you get into the website, we have a page for Sunrise Village and then a page for Sunrise Place. So that way we're spending our marketing dollars driving to one singular website. That way if someone sort of comes in looking for a 3-bedroom but decides they want a 2-bedroom or vice versa, they kind of see what's available.
In the group that you got kind of the lead from, the management company, are they managing the asset for you?
They are. They were currently managing the asset, and they were already our chosen property management company. So we decided to keep them on, which presented a little bit of an issue during due diligence where they didn't want, and no one wanted them to have sort of a conflict of interest.
Right.
So we actually had to take a little bit more on ourselves and hire a little bit more third party to come in during the due diligence period.
Is there any surprises that came up in due diligence? I mean, sometimes it's hard for even as the lender, right? So we can talk about how you finance the property, but then the lender's saying, well, it's the same management company, so what's going to change now? once you guys come in. So maybe talk a little bit about your rehab budget and how you finance the property.
Well, like we discussed earlier, the two properties are definitely different. You got the one that is the townhomes, nicer property, a little farther away from the campus, and in that one, we knew that there's three things when you're talking about CapEx: deferred maintenance, interior upgrades, and amenities. With the Sunrise Village, the focus was going to be on interior upgrades and the amenities, like we talked about. So with those those bigger units, we noticed that we could get about a $200 bump based on putting a certain type of upgrade, which included forward floors, two-tone paint, light fixtures, and black appliances, correct?
Yeah.
Yeah, and so that's been working. We haven't started really implementing that strategy to its full potential. We're waiting for the more leasing season to take effect on that one, and then of course the CapEx included those two amenities, which we talked about, and we're gonna look into that with the tennis courts. Now, Place, it was a little different. Every property has always a different model, different business plan. That one, it was more of your basic upgrade, real standard upgrade, nothing fancy. We knew that if we just took care of the deferred maintenance, made the outside look a little nicer, made those units, interiors just a little cleaner, we felt that we could get a $75 rent bump on those. So two different properties, two different business models, and we had to figure out how to put that all in the CapEx.
Correct.
And then how did you guys decide to finance this property?
Well, in consultation with you, James, we decided to go with a Fannie Mae. I knew that I wanted to go ahead and get long-term debt. So we were looking to get a 10 or 12-year term as part of our business strategy. While we do look, we have a plan to exit the property in about 5 to 7 years. If we're at the bottom of the market cycle, we wanted to have that extra runway. And also in consultation with you, we were deciding between Fannie and Freddie. And we decided after looking at the options that we thought Fannie was better. We had a pretty substantial CapEx budget, and we felt that we could get more loan proceeds in going with a Fannie loan. And we ended up getting a 12-year term, 30-year amortized non-recourse loan with Fannie at a great interest rate. Yeah, 3 years of interest only.
And to add to that, I really love the 12-year loans. I mean, it just allows an opportunity down the line where if things possibly are not going as well, that 4 to 5 year plan is not looking like what it needs to be, that you can hold on to it and wait for that cycle to change where we could, it'll help that, all of us benefit, including our passive investors. So I really love the terms on this: 12 years, 3 years IO, up to 78%. Pretty fantastic.
So James, typical client of yours is what we're talking to. What is your counsel when you're talking to folks just like this? I mean, what are some of the things that you're pointing out to them?
Yeah, so a lot of times we'll look at T12 rent roll and sort of figure out what leverage point we're going to be at. And then on this particular deal, we could have taken it either two ways. We could have taken it Freddie Mac, but in some of the smaller markets, they're going to be capped out at 75% loan to value, so not even rolling rehab. But on this particular deal, there was enough cash flow that we could push right up against that 80% and roll the rehab. And so they were getting more loan dollars, more interest only on a Fannie Mae loan. And so that's why we decided to go with Fannie Mae on this one.
So tell me, guys, a little bit, why do you think the seller picked you? As of all the people that put bids on this deal, why did you think they picked you besides Matt's good looks?
Oh. Thanks, Paul. Well, what happened, this was an interesting story, the way that we acquired the property. The property went to market, and it went at a rather high price point. And I spoke with the broker about it and said, this seems kind of, really out of reach. I was way off on my numbers. And she's, encouraged me, hey, put in an offer at what you think you can offer. Don't be discouraged by, what the price is. We'll see where things shake out. So I submitted an offer. They actually, about a week before the call for offers, they lowered the pricing guidance, but we were still pretty far apart. And the feedback that we got after the call for offers, there was a bit of silence. And then the response was the sellers decided to take it off the market. They weren't getting the money that they wanted, and they decided that they were going to go ahead and implement their own capital improvements program, bring the NOI up, and then bring it back to market, maybe around this time. They were going to hold it for, 3 to 6 months or whatever. And so I kind of didn't take that as a for an answer. I wanted the property. So I kind of went after it. I got more aggressive on my pricing. I had built a rapport up with the broker and continued to do that and spoke with her. I ran new calculations of like, okay, well, if they spend X amount, then it's going to bring an NOI up this amount. But hey, what if interest rates go up? Because at that point, we were really worried. I think a lot of people were worried about the interest rates, and interest rates were going up. And, hey, they were going to have this interest rate risk. And I really worked it for about 2 to 3 months. And finally, we got the seller to agree. I mean, I came up in pricing, they came down in pricing, and we sort of met, not in the middle, but we met. We came to an agreement, which was fantastic. I really liked the property. I really liked the submarket. And I kind of I feel like maybe I'm not like a big fisher or anything, but I felt like I kind of had a fish on my line and I wanted to reel it in. So I fought. I really had to fight for it. But, after having gone after deals for a year and a half, and I was just like, I'm getting this one. So, and getting it, I could have gotten it at a price that didn't make sense, but I wanted to get it at a price that was going to be really good for me. I was putting up a substantial amount of my money
Personal
into the
wealth,
deal. Yeah. And also for my investors, which is very important to me to protect those investors.
So you had a fish on the hook. Was the fish fighting back? Was there anything in the financing or in the underwriting or the due diligence that the fish said we may have some problems with this deal?
Not too much. When we did the due diligence, there was some deferred maintenance that we were unaware of, specifically the pools, right? Mm-hmm. There was some issues with the pools that was not clear when we did a tour. We toured the property. They were getting the pools ready for the season, and they were like green at the time. They were just starting to turn them on and get them running. So we were not able to actually see physically when we did our tour of the property the problems that were there. Beyond that, during due diligence,
the financing was moving right along. And one thing I not just with this property, but with multiple properties, is sometimes the sellers decide to take their foot off the gas and they don't continue to do the upgrade program to collect like they need to. And that's one thing we're always keeping an eye on. And of course, the fluctuation of the interest rate at the time. So, I think a big part of it was you guys. I mean, we went back to the underwriters and you helped us get, more proceeds. We had a tax issue that came up, and, it was something that we had underwritten a certain amount of taxes, and I think the inspector or the underwriter decided to underwrite them a little higher. And so that's when, Matt got on the phone and said, no, I got we have a tax consultant, and you can share with them that story. But that was a big one. And we were able to pull it off with y'all's help. So that was huge. That was going to really hurt the total returns, and we were able to get it done. So that was good
James
stuff.
and coaching counseling with that?
There was another thing that might be very interesting for people to know about, which was we had a change in the Fannie Mae guidelines while we were going through the financing. So our initial plan was to buy both of these properties with individual loans, because the combined total was enough to get us, I think it's a $7 million mark. You guys could correct me if I'm wrong. And at the time, it seemed as though it was going to be fine. Fannie Mae would let us combine them. Well, by the time we actually got to that, to putting the loan together, they changed their guidelines within those 3 to 4 weeks, and they would no longer let us have 2 separate loans. So we ended up combining the loans, which was fine. It didn't really hurt us that much, but that was a surprise for us.
Yeah, the combined loans, a lot of times, if it's over, I think right now it's either 6 or 7 million now. If it's over that loan amount, then you just get better pricing. And so on these deals, we thought maybe we start individual if we could, and maybe try to get a waiver from Fannie, but they really wanted one loan together on that piece. And then on the taxes, the good thing you guys did was the appraiser sort of came in with a number that was pretty conservative at the beginning. And we got on the phone with a tax consultant that you guys were going to use in that market and sort of laid out the facts. And that was able to get us a little bit more loan proceeds. So, when you start the process, definitely, walk through the steps and be prepared to back up all your underwriting on these deals, because the appraiser or even the lender's underwriter can come back with more conservative numbers.
Yeah, the good thing was I had already reached out. Actually, Justin had advised me to do it to the tax consultant way early on in the underwriting. So I was certain of my numbers. And so as soon as it came back, it was like, no, here's what it is, and here's who you can talk to. And so it wasn't too painful.
Yeah, James, a lot of people only know single family real estate stuff. And so they really don't understand maybe the equation that comes in when you have higher property taxes and what that means as a line item and how big of an impact that little piece can have on your loan dollars. Can you walk and tell somebody a little bit what that means, what kind of an impact it is if you don't do something like what these guys did?
Right. So let's take, for example, your income minus your expenses, you get to 125,000 net cash flow or NOI. And then your debt service is 100,000. So that'd be a 125 debt service coverage. If there's any increase in expenses, let's say real estate taxes or insurance, that can reduce your net cash flow, let's say down to 110. And so all of a sudden, the debt service is still $100,000. And so they have to lower the loan amount in order to hit that 125 debt service. And so a lot of people think that, they're really just going to get an appraisal. And if it's less than 80%, then we're good to go in terms of loan to value. But they're also looking at that debt service coverage to make sure that the property has enough income to really support the loan that you're going to give them.
Absolutely. So a little piece of additional expenses can have a large ripple effect down the road of how many loan dollars you can qualify for just based on that 125 debt coverage ratio.
So since you guys closed August of 2018, has there been anything that you've learned sort of post acquisition that maybe you could have done on the front end, or any good or bad surprises that have popped up at the properties?
Yeah. Well, we have an interesting tenant
Yes.
who has a monitor lizard, which is he also has like 6 other snakes, including boa constrictors and all kinds of reptiles. And he has frogs and he has turtles.
Did you see that on the walkthrough?
We did.
Okay. All right.
And
does he pay rent?
He pays
does.
rent. He's a model tenant, but
Model tenant,
we
yeah.
did have concerns with that amount of reptiles and doesn't necessarily meet the city ordinances. So we checked in with the city and we spoke with the tenant. They're fine. Everything's fine. But that was a surprise for us.
It was, and something that you immediately want to do is obviously let's get this guy out of here, but it's a little more complicated than that. So
Is there a pet rent income line item for him, or is it?
Well, not for him. We do have pet rent, but these animals are. He has letters from his doctor there. But what do they call it when you have a?
It's like a service animal.
Not a service, like a comfort animal. I forget what they call it. You'll see people.
But it's a boa constrictor.
The
This is
expression on
crazy.
my face.
Yeah.
Can you bring the animal, the snake on board and
I
let it
think
sit
a
next
plane.
to you?
Yeah, I think so. Yeah.
Yeah, no thanks.
pretty wild stuff. but
Yeah.
I think we gotten that one covered.
So that was a surprise.
Yes.
Other than that, I don't think the great thing about having the same property management company was I think they were very open with us and disclosing where things were and sort of where the bodies were buried, if you will. So I think we went into this pretty eyes wide open.
did.
I mean, there were some bad things, but nothing that was a big surprise.
No, there wasn't. And just to add to that, you mentioned that we took on the current property management company. There's definitely pros and cons to that. And like you mentioned, finding those buried bodies is important. But it's also important that, when you do take it over, that they have they're on board with your business plan. They're on board with how much you're increasing rents. And so that could definitely be the challenge. But for the most part, I think it's been fantastic. I think they've been a great management company, and we kept the property manager, of course, the regional we have there. And so they've been on board. And of course, it takes leadership. And that's where I feel like Matt has been doing a fantastic job with the asset.
Well, I'm sure that they were happy because you were giving them almost a little bit of a blank check to fix some of the problems that they had with the past seller, and then now they can be kind of a little bit more proud of the property to fix some of the problems. And that's one of the things that a lot of ownerships groups is they starve the property, and the manager and the management company looks bad, and it's only a reflection of what the ownership actually has in their checking account that they can spend on the property.
Yeah, I think you're right, Paul. The previous ownership had the property for 12 years, and they actually had a, less than stellar property manager on board for about 10 of those years. So when the current property manager they came on board, they were cleaning up a big mess, but I think they wanted to clean up more and were faced with a dollars challenge.
Let's talk a little bit about dollars. How much money did you guys have to raise? in this deal?
$2.63 million.
So $2.63 million.
Yes.
And when we're talking to investors right now, again, we're trying to change the thinking that you can make 1 or 2 or 300% in 2 years or 1 year, something like that. You know, we want to get back to realistic numbers and to tell people, you know, this is a hard asset you're buying. You know, if it's going to be cash flowing in the ballpark, what type of return are investors looking for today on their investment dollars?
Well, the type of return that I think people are looking for, at least within the group that I'm in general, I think we're looking for, you know, maybe 70+% ROI in about 5 years. Mm-hmm. And maybe high single digit or low double digit cash on cash returns. Justin and I were really happy about this deal because our projected ROI in 5 years is over 83%.
Wow.
We'd be at 102% in 6 years, and our cash on cash return is over 11% annually. So it's a very strong cash flow market. Yeah. We like to see where we've got returns where the cash on cash return is going to be high and more than 50% of the returns.
Yeah, one thing I've noticed is in some of these secondary and tertiary markets that people are looking at, including us, is that the cash flow is higher. And, you know, when we're looking at deals, for instance, in Dallas-Fort Worth, of course, everybody wants to be in Dallas-Fort Worth, but it's hard to come by those 9-10% these days. And so I think that's why a lot more capital is being moved to the secondary and tertiary markets, is for the fact that cash is king. On the back end, we have reversion cap rates, and we try to come up with what we think we're going to be able to sell it in 5 years, but we're pretty much made it, you know, it's a guesstimate of what we think will happen based on historical data. And so when you're able to see a deal that's cash flowing over 10%, cash on cash, but might not necessarily have a high overall return, I would jump all over that all day long compared to the reverse. So that's one thing I noticed for sure.
And what are your plans for this upcoming year? Like, are you guys focused in that market? Are you looking at other markets? Sort of what are your goals for this year?
Yeah, I mean, my own personal goal is to add 300 units to my portfolio. You know, fortunately, I'm in the best and final for another property in Kansas City, so we'll see how that one goes. But I'm continuing to look in the Kansas market, but also, I should say Kansas City, which is a lot of Missouri as well. Also continuing to look at deals in Florida, and I've partnered with a couple other people in the group that I'm in. We're looking at deals together, and if we find something that makes sense, we'll look at partnering on other deals. It's really a team sport, so I'm definitely open to and interested in working with people on different deals.
Yeah, same here. Looking to do additional 2 or 3 deals this year that makes sense. I feel like the multifamily market is going to continue to stay strong in 2019, and it looks like we have a lot of confidence from Fannie and Freddie to lend in the multifamily sector, especially the B and C class properties. And so continuing to try to help students within the program get their own deals, but of course I want to build my portfolio. So definitely 2 to 3 deals that make sense, and hopefully in those secondary and tertiary markets where we see strong cash flow.
So what advice would you give someone sort of going from 0 to 1, trying to win that first deal?
Well, commitment. I think too many times people get into too many different types of businesses. In my 20s, I was all over the place. Jack of all trades, master of none. I wanted to dive into all these different types of businesses, and it wasn't working. And finally, in 2014, when I made it the commitment that I'm just going to do the State Fair, Texas, in multifamily real estate, and in 10 years, that's what I'm doing. That's what I'm doing, and stay committed. And if you look at commitment, that's where this guy comes into play. I mean, he's been consistent, committed, and he's going to do very well in this business. So that's my thoughts.
I think there's 2 things. The first is, like I said before, being a team or partnering. You know, you look at someone like Warren Buffett, right? The Oracle of Omaha. He's got a partner, right? And so, you know, I love having Justin as a partner, and we're looking to hopefully do a lot of deals together. But I think being willing to you don't need to be a solo person, and especially in this business, I think is really important to partner with people. So I think that's something. And then the other thing I would say is just the persistence. Yeah, I think I mentioned that several times during the conversation today. I think just keep going at it. You know, get yourself a good mentor. I mean, there's a bunch of, you know, I love the system I'm in. There are other systems out there. I think some of them are good, but some of them are bad. So I would do serious diligence on who you're going to have as a mentor. But, you know, using a mentor, I think you can go further faster. You know, you can learn from their previous mistakes instead of learning them on your own. So I think that's important as well.
Yeah, you know, you're right. The team is a big one. And I was a single family guy, and I'm sure there's a lot of single family guys that are on the call or on the podcast listening in, is that the transition for me was an individual sport to a team sport. The team sport, partnering on the right people, finding the right mentor, getting a good mortgage broker that you can trust when they send you a term sheet, that's going to be the numbers you're going to get. The management company, all that. You don't have to know everything. You just have to know who knows that information. And I think that's the most important thing as well.
And if people want to reach out to you guys, either learn more about this property or some of your future properties, what's the best way for them to reach out to you?
They can go to my website at skycastleproperties.net or reach me at 817-996-9968. I'd be happy to answer any questions.
Yeah, and people could reach me at my website, which is mjppg.com. You could email me, Matt, M-A-T-T, at mjppg.com, or you can call me at 646-522-1369. I love talking about real estate. I help people out all the time who are just starting off, and I love talking with experienced people. It's my favorite thing to do. It's my full-time job is being a real estate investor and syndicator, so please feel free to reach out to me.
That's great. We appreciate you guys coming in and telling us a little bit more about your story. And it sounds like it's going well, and I know it's going to continue to do well. So thanks, guys, for coming in. Justin, always a pleasure.
See you at the State Fair.
Look forward to seeing you at the Great State Fair of Texas. When's that coming up here?
It's in October, so we have some time.
October.
I'll invite you to the fry party. How about that?
That's great. Matt, thanks for traveling all the way down from Boston. We do appreciate spending some time with us. The Grand Inquisitor, James Zhang, thank you very much. We appreciate it.
Thank you, guys. Appreciate it.
Thanks, everybody.
I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.